Okay, folks. I went back to the basic corporate chapter on mergers and acquisitions in the priority textbook, if you still have that one. And then I put the PowerPoints on for that in chapter 6. So chapter 7 is the mergers and acquisitions. I'm trying to get a better overview because I think the textbook just kind of dives in it like you're supposed to know it. So I'm really starting from zero to try and talk about this stuff. So I'm looking at some basic textbooks and some other things. My objective here is not to teach you this stuff because this is not what I do. We have somebody coming in as a specialist in this, but I wanted you to have a lot more exposure than prior classes have when he comes in. So have kind of have a little bit of a feel for it. So the big picture is he's going to be talking about taxable acquisitions and the reorgs that are so-called non-taxable acquisitions. He's going to be giving you ideas and rules and those sorts of things about when you might want to do that. I think he's going to divide you up into the classes. By the way, the week after the exam is the first time he comes, and I won't be here. So the only thing I'm worried about is, will this room be unlocked? And I don't even know if my key works on it. This is like coded by time thing, and I don't even know. Say again? No, it's been unlocked, and I think we're okay. And I'll give him as much backup as I can on it, including how to get on this computer and how long you have to wait to boot out. I mean, God forbid if somebody turns it off. I'm serious, it takes like 10 minutes. But anyway, these are my problems. Paul is really good. He's a graduate of USF. He has a Master of Accounting back when we had a tax track years ago. And he's working with a large firm. Kermit is their old name. Anyway, they're in St. Pete, but really at Feather Sound, that area. Good firm. Okay. Anyway, I think you'll enjoy what he does and how he does it. But what I wanted to do is give you some tools so that maybe you have some basic understanding, recognizing that I had a mergers and acquisitions course many years ago. LLM and tax. And I don't do mergers and acquisitions. Anyway, okay. So you have a taxable transaction, and again, he's going to get into this more, but think about this. If you're a buyer, you want to buy a business. It's in a corporation, a C Corp. How would you like to buy that? What's your basic choices of how you would buy it? You want the assets, you want the business, etc. How might you buy it? Excuse me? If you have cash. And what are you trying to buy with that cash? Pardon me? The assets? Or the stock? Okay, so she's got the answer. You're either going to buy the stock or the assets. Now let's think about that from a buyer's point of view. If you buy the corporate stock, what do you get with that? You get all the liabilities that are there, plus the hidden liabilities. You get the whole package. So maybe you'd like to buy the assets for a number of reasons. Let's suppose the assets have gone up in value. So inside the corporation, and again, acquirer or acquiring corporation and target That's terminology you want to kind of get used to. So you have a target corporation, you're either trying to get the assets or the stock. The buyer generally would like to get the assets because you don't get the liabilities with it. Now you may be stuck with having to buy the stock for a lot of reasons, one of which might be maybe you need the name. But you may be able to get around that. Okay, so you're going to buy if you buy the assets, then you get a step up in value to the fair market value, and if they're depreciable assets, you can write them off under the depreciation rules. Now, think about the seller. What happens if you buy the assets? The corporation probably is going to have a great big gain. So, we did some of that liquidation of corporation stuff, you recall. And the corporation, when they sell the assets or they distribute to the shareholders, either way, here they're selling them. Now they have a gain or loss that they report on their tax return. Now, if they've got a great big loss carryover, then maybe they can take care of that. You understand? But if they don't have that, they're going to have a gain at the corporate level, and then what else is going to happen? They're now going to distribute what? The cash to the shareholders. Is there a gain at the shareholder level? Yes. So if you're a shareholder, what would you like to happen? What would be better for you? Pardon me?
Stock sale.
Yeah. Why? Why is a stock sale better for yourself? Long-term capital gain, no double tax, right? Okay, so these are some of the issues that he's going to get into when he talks about taxable types of transactions. Now, if we go to the so-called tax-free reorg, which is a misnomer, we know it's tax deferred, just like tax-free exchanges are tax deferred, but anyway, we'll use the terminology. Then the acquiring corporation is acquiring either assets or stock, and it's going to be non-taxable to the acquiring corporation, assuming they're using their stock, some of their stock. And the same thing for the acquired target will be non-taxable for the acquired target. And so the target's going to receive some stock, the acquiring corporation stock, and then they're going to turn around and give that stock ultimately to the stockholders of the target corporation. There's all sorts of rules about continuity of continuation of business and continuity and those sorts of things. And a lot of these rules came about with cases. It's case law. And with case law, it's sporadic and they're not always in line and everything. And so the IRS has a lot of regulations that they've written. And of course, they will rule in this area. They have ruling positions that would tell you what kind of continuation it has to be control-wise and those sorts of things. So, but that's what you're dealing with. You're dealing with taxable transactions where you buy assets or stock, where you sell assets, the corporation sells assets, the target corporation or the stock, and the consequences to the acquired corporation's shareholders when they receive, the acquiring corporation's stock, etc. So that's kind of what you're dealing with. So again, in looking in the textbook, and you're going to need your code. I want to open it 368, so you've got it there. Okay, so look at 368 and kind of take us through the so-called tax-free reorg section. The first one is a statutory merger or consolidation. Now we're going to go through these PowerPoints. I went through them a couple of days ago and I went, this is a nightmare. And then I went through them again today and I went, okay, I can kind of give you an overview from it. What you have to understand is you're getting so much detail from me and these PowerPoints and stuff like that. When I put together test questions, I'm not going to ask you these real fine points at all, okay? The questions are going to be much broader, but I want to give you enough incentive to study for it so that you'll have some basis for when Paul comes in to talk to you. And then I think you'll really get a lot more out of his presentation because you'll have some fundamental, you've heard these things, target corporation, acquiring corporation, tax-free and taxable transaction, that sort of thing. So let's think about statutory merger consolidation. That involves, you look at the state statute. Are all state statutes the same? No, in fact, they're noted for being, sorry, I just squashed them.
I'm sorry.
They're noted for being different. And lawyers that specialize in this a lot of times use not Florida. They use other states because of the more favorable. There's been more litigation. There's been more. Let me pull this. Step on it again. Is it still up there?
Yeah, it's okay.
Okay. Anyway, what's the difference between a merger and a consolidation? For the CPA exam, you got to know. It's a basic formula. Let's think about it. A merger, you're going to have the acquiring corporation is going to be the surviving corporation. So, just for the little formula for a merger, A plus B equals A. A plus B equals A. A being the acquiring corporation is going to be the surviving corporation. What's a merger? Well, a merger is where we're going to have a different corporation when we're all done. We're going to have A plus B equals C. A plus B equals C for consolidation. And again, for the CPA exam, that's what I teach, just so you know the difference, because that's all you need to know for the CPA exam. It's really pretty fundamental. Okay, so we have a statutory merger or consolidation. And what I'm going to do is I'm going to go through these reorg characteristics. I grabbed a book, my last shot at it was a different textbook. I used to use this years ago, and I said, I wonder what they've got. And they've got a reorganization characteristics chart, which I can't photograph and give to you. It's a violation of copyright, but I can kind of highlight it. So what I'm going to do is go through these. So merger, and then the B reorg is, and again, you can write this in your code right beside it. In the B reorg, it's let me just shorten this for a second. Let me just be sure I've got the right order here. Okay, this one's pretty easy. This is stock for stock. The B reorg is stock for stock. So, to be a little more precise, it's target stock for acquirer stock. Target stock for acquirer stock. That's a big stock for stock. And somewhere you might just put 80%. That becomes important later. But you're looking at 80%. A C reorg is the target's assets for the acquirer stock. Target's assets for acquirer stock. And a D reorg is target's assets for acquirer stock. Yeah, but it's done differently because with a D, you usually end up with two corporations, and you're trying to get some of the assets, but not all of them, so it's a little different that way. E is a recapitalization, and that's just dealing with one corporation. So traditionally, that's where, my wife and I started this business, and we've really grown it and everything. And now we want to retire. We have kids that are going to come into the business. And all along, we started planning this a long time ago. And then we said, you know what? Let's come up with some preferred stock. So all we have is common. Now we're going to have preferred stock. And maybe non-voting preferred, whatever. Or we might have common stock voting and non-voting common stock, you know, those sorts of things, is to try to use that to kind of move the ownership to the children, although we don't like to move it too fast. But anyway, so you have a recapitalization. But it's one corporation just changing its capital structure, usually for estate planning purposes. An F reorg is a change of identity, form, or place of organization. That's, again, one corporation. Is not really one of these acquisitive things at all. G is, I think that's really in bankruptcy. It doesn't spell it out in the code section, but that is one that's used also. So all of these are tax-free reorganizations, and if you meet the qualifications, that means that the acquiring corporation or a subsidiary that the acquiring corporation has formed that they still control is going to succeed to the all that tax basis of the acquired, the target. In other words, it's tax-free. And remember, the way tax-free works is you don't get a step up or step down in basis. You get the old basis. So all these reorg sections, you get the old basis. That's the way that goes. Now, in some of these, you may have minority stockholders of the acquired, the target corporation, and you may buy them out, and they probably are going to have a gain or loss, those shareholders. Because they didn't end up with the acquiring corporation stock at all. So they're going to have a gain or loss, you know, their basis, their stock versus what they got. The other shareholders, though, that end up with the acquirer stock, they're not going to have a gain or loss until they sell the acquirer stock later on. When they do, they'll have a gain. Because remember, they have to sell their old basis from their old stock. So that's kind of, again, I'm trying to give you the big picture. And I'll be honest with you, last week I felt horrible. I just didn't like anything I saw. I didn't think it was understandable. And then I worked on this stuff, and I actually feel a whole lot better now. So now I'm trying to convey to you what I learned, you know, messing with this stuff. Okay, well, we're still going to do the problems that are in the chapter, you know, and I'll give you the comments of the study guide, the teacher's guide. Okay, all right, so now, let me be sure you're taking good notes now. Now, this is off this reorganization characteristics chart out of this book. It's the Pratt book, P-R-A-T-T. Again, I don't know. I'm just telling you so you know what it is. Okay, so with A, we're going to start with A. Merger, a merger, and you know the columns we might have here. Probably ought to make this. Oh, we have the type. And we have the acquiring corporation. And we have the target. Okay, so with the A's, you know, A is going to be a merger or consolidation. And okay. The acquiring corporation, now what are they transferring? They're transferring their stock. That's, I think, basically for both of these. Stock. They can also transfer securities and some other property. So stock, securities, and other property. That's what they're transferring. What are they getting back? They're getting back targets. Assets and liabilities. So notice they're getting all the liabilities. Yes?
Will securities include like the bonds and everything like that, or no?
It could, but you have to be careful because it has to be a certain amount of equity security, so some of those bonds and things don't count as equity at all. Okay, so what's the target giving up in these? All of their property and liabilities. What are they getting? Okay, yeah, they're transferring that, and they're going to go out of existence. Their identity's gone. And that's the same for both a merger and a consolidation. Same stuff. With a B, which is called a stock acquisition, the acquiring corporation is going to transfer solely voting stock. Notice up there they did stock or securities plus some other stuff. Solely voting stock in a B. And they're going to get back stock in Target. And it has to be controlling. And what do you think might be a controlling percentage? Take a guess. It'd be 80. I think that's why I said stick 80 somewhere. All right. Okay, so that's stock. The corporation is going to transfer most assets, excuse me. They're going to get back voting stock. And there's variations on what you do after that as to whether the corporation has to stay in existence or not. There's different rules on that. Yeah, I'm sorry, I've got that. I misread that. I didn't understand how they transferred assets. Okay, so the corporate stock's going. Okay, in an asset acquisition, it's solely voting stock, plus you can give some other property. So these are ditto marks. Solely voting stock, plus some other property. They get back substantially assets of the target and they transferred all the assets, substantially all the assets, and they get back voting stock. Of acquirer.
On B, is the target giving us stock?
Say again? In what?
And B, a stock acquisition.
Yeah.
How are they not giving that? I mean, they're giving us stock, right?
Yes, they're giving up controlling interest in the stock of the target.
Okay, so should that go in that? Yeah.
They're transferring solely, they're getting back stock in the target, which is 80%.
Right, so the target would be giving up.
They don't show them giving up anything. The target corporation itself is not giving up anything. The shareholders. The shareholders, you're going directly to the shareholders, so that the target corporation still exists completely.
Okay.
So this is, again, shareholder, I guess, to make it more clear. Okay. I think C can be acquisitive, and I don't really want to get into the difference on that, diversion versus acquisitive. But C can be both. This book says that's the only one, but I think other textbooks say that a couple others happen. So D, the corporation gives up some of its assets. And they get back controlling stock. So what's going to happen there is, I guess the target corporation is going to get some assets. The acquiring corporation is going to be in control, and then probably ultimately those assets are distributed to the shareholders. Sometimes you're allowed to keep the corporation in existence, so maybe they keep some assets. So that's going to come in, and I'm not trying to differentiate from that. And that's really the important ones. G's bankruptcy. The acquiring corporation gives some of its assets, gets back stock. So again, corporation gets stock, etc. So I don't know if this is helpful or not, but at least it gives us some sort of feel. Because what I want to do now is go through these PowerPoints. Does anyone not have a headache yet? Well, you're going to. Again, we're trying to do more of the big picture. So there's some stuff here where I'm just going to say, let's not worry about that. But try and see if I can. Okay, so we have acquisition of the target. We're going to buy stock, and this is more of an overview. So if you're going to buy stock, you buy the stock. So the corporation, you have a parent subsidiary, maybe it just stays that way. Or you have a parent subsidiary and then you merge the subsidiary into the parent. Remember we talked a couple of weeks ago that is not a taxable event, it's a carryover sort of thing. we're assuming you have 80%, you meet the requirements of whatever code section that was, 230, whatever it was. There's something called 338 where you buy the stock, but you can make an election that, so it's treated like an asset purchase. And 338H10 is a real specialized. This is an area that, you know, I just want you to have heard the words at this point. But if you buy the stock, you're normally stuck with a carryover basis. And if you don't want that, the acquiring corporation can make an election. And what it does is it forces the target to be treated like they sold all the stock. They sold all their assets in the corporation, and they recognize gain or loss on those, and then the corporation, the acquiring corporation gets to step up usually in basis. Now, you really can't do that probably unless the target corporation has a great big net operating loss in there that they could use to offset the tax on this pretend sale, section 338% sale. Okay, so it's highly specialized, and then 338H10 is another special one, which I'm not sure. We're really beyond what I want to get into at this point. But so they're talking about that. That's what it is. You have a stock purchase, but you treat it like an asset because you can make an election. The target is treated like they sold the assets on the next day they're a new corporation. Everything's separate on basis. So then you can either go back to just have it as a sub, or you can merge it into the parent. You get to step up in basis. And again, if there's no huge tax cost to the sub because they have net operating losses, then it might be smart. Okay. So, you know, like I'll go up to the Southern Federal, in a couple of weeks, and I say, have you done a 338H10 yet? Huh? Okay. All right, so an asset acquisition, you buy it, whatever the purchase price is becomes the acquiring corporation's basis. The selling corporation recognizes gain or loss. This is a taxable transaction. So the acquiring corporation has a new holding period, and it can occur all sorts of I think this is state and local. I hate abbreviations on these things. But, because I looked at the textbook and they didn't really spell it out, but I think it's state and local taxes. But what are state and local taxes? Sales tax, property transfer taxes. If you buy a company that has 100 dump trucks in their name, you have to transfer 100 trucks. In Florida, if you're putting a new tag on it, it gets kind of expensive. You see, you don't have a tag to transfer. Anyway, so those type of things, there may be sales tax, unless it meets the bulk sales rule, all sorts of things like that. Transaction taxes. So you have to worry about that. You can buy the stock and just keep the subsidiary around. We have the parent acquiring the target. The parent has the cost basis of S. In S is stock, and then just let the subsidiary target operate. All of the target's corporation, all of S corporation, basis, depreciation, elections, credits, and everything, because it's still an existing corporation, they're stuck. You're stuck with whatever they have, and maybe other properties depreciated a lot. Again, you could buy the stock and then liquidate the sub into the parent. And, from a planning point of view, and we'll talk about it a little bit, you may want to flunk the 80% rule and have it be a taxable. Again, you're trying to look at the totality of what you're trying to accomplish. Do you want to step up in basis? Is depreciation more valuable to you or not? And there's all sorts of rules about that. Okay, so you buy the stock and you liquidate it. Okay, what happens when you do that? The parent has the cost basis in essence stock. Again, we're talking about parent subsidiary 80% liquidation. When the sub is liquidated, there's no gain or loss. There might be realized gains, but there's no recognized gain. So your basis and holding period carries over the parent's basis in the stock does disappear. And so if the purchase price was less than the adjusted basis, you've lost basis because you're limited to the purchase price. If the purchase price is less than the adjusted basis, then you're picking up the basis, which is good. So, does everyone get that? You know what I'm talking about? So if you buy an asset, if you buy stock and it's a parent subsidiary relationship and all the assets have a zero basis for tax purposes, whatever you paid wasn't too smart. You understand what I'm saying? You're not getting the benefit of it. Okay. Okay, from a practical consideration, and again, we're talking about asset and stock purchases. Purchasers normally would prefer to buy assets. Again, we've talked about why you don't want the hidden liabilities. You can pick and choose. You don't have to buy all the assets. You can pick the assets you want. If this person would rather sell stock, okay. Sellers would like to sell stock to avoid the tax liability because the corporation would have a sale of assets, then on liquidation you'd have a sale of stock. No situation. And the 338 election, I don't know how useful this is, but we've got the parent subsidiary step one. The parent after they buy it makes a 338 election. What that means is that the old target is going to be treated like they sold all their property for the fair market value, and so now you have new target with the upgraded basis because it's a deemed or pretend sale of assets for the ADSP. We all know what that is, right? Not really, but anyway, it's the adjusted something sales price, which is right somewhere around here. Okay. Okay, so the purchase of stock with a 338 means that the new target has a new basis in assets based on the ADSP, which we'll see in a second. Probably should only do this if the old target has net operating losses to offset the gains. Otherwise, you owe the IRS some money. You see? The parent needs to own 80% or more within a year to meet the requirements of the control. Okay, here's the ADSP. I'm only going to give you one question on this, and I'm joking, okay, just so you know. But anyway, it's the aggregate deemed sale price, and they go through all sorts of calculations. I don't really care about it at all. Okay, so the 338 election, the parent now has new target. You've got the step up, hopefully in basis. It was the purchase, and the step up is the purchase price of the stock plus target liabilities and target tax liabilities, and tax and non-tax liabilities. You can add all those to the basis, which you can depreciate it. Now, the problem with this 338 election, and again, we're probably going a little too deep. I don't expect you to regurgitate this at all anywhere, but it is kind of neat. You get the step up of the adjusted gross up basis, but you have to allocate over your assets. So, and there's a rule, and there's different classes of assets, and again, cash, marketable securities, accounts receivable, inventory, other assets that aren't in other classes. And then section 197, intangibles, those are the intangibles that a few years ago the IRS got Congress to put through a change in the law, because people would acquire a company and they'd say, well, we've acquired this list of clients, but it only really has a real useful life of 3 years, and so they'd write it off over 3 years. And you have a covenant not to compete, traditionally 5 years, and you'd write it off over 5 years. Well, 197 said, oh, and by the way, goodwill you couldn't write off at all, pretty much. Well, 197 was put in there and basically said all these intangibles, covenant not to compete, lists, all these goodwill type of things where you can show a shorter life. By the way, the reason they went to Congress to get them to change the law is the IRS lost all of these cases. A taxpayer would go and say, well, look, this list is only good for 5 years. We should be able to write it off over 5 years, right? Yeah, and so the court would agree. The IRS lost another one, so they got sick of it. So they went in and said, look, let's put everything in here. We'll let you write off goodwill. Everything's over 15 years. It's probably technically 180 months, but 15 years. 15 years. Goodwill. So the level 6 allocation is intangibles other than goodwill, and then the last one is goodwill. But if you're a Section 197 asset, you gotta write them off for 15 years. So if I buy out your business and I pay you a covenant not to compete for 5 years, which is ordinary income to you and deductible to me as an ordinary expense, the fact that after 5 years you can compete with me, sorry, you gotta write it off over 15 years. That's what section 197 says. So, not necessarily great for the taxpayer, but hey, the IRS doesn't represent the taxpayer, yes.
Is there a reason we should know why the allocating is different for the goodwill?
Good, I'm sorry?
Why goodwill is allocated different?
Well, I mean, it's just, everything's based on fair market value, and if there's something left over, if you paid more than the fair market value of all these assets, then it's gonna be down in 6 and 7. And if it's just goodwill, then you don't have any 6. You don't have covenants not to compete or other things, you're probably down in 7. And that will pick up what's left. And, you know, this could be on the CPA exam, by the way, this is not bad stuff to kind of play with. You're not gonna get too technical, but the bottom line is, you know, what did you pay versus what's the relative fair market value? All right, so 338 election, the impact of the new corporation. Well, you start over. You have new elections, which are tax planning opportunities. You can file a new tax year. All the tax attributes from the target are lost. So if you have unused net operating loss carryovers, you're out of luck. They just disappear. So you got to be. That's why you've got to be really careful about this. Okay, taxable versus non-taxable transactions. We have stock or cash or property from the acquiring corporation to the target. The target shareholders receive stock or cash or property, and the target's assets and liabilities go up to the acquiring corporation, and then finally the target is liquidated. But see, that can be taxable or non-taxable. Okay, depending on, you know, the different things. Okay, if it's taxable, you can use whatever you want to buy it. The target has a tax liability within the corporation. The target shareholders have tax consequences when they get a distribution. It's not a non-taxable transaction. The acquirer has a fair market value basis in assets, starting over a new holding period, start the depreciation over, you know, no 1245, 1250 recapture because you're starting over. And T, the target's tax attributes are gone. So that's not taxable. Okay, in the non-taxable, generally you have to, the acquirer has to use their stock. There's no gain or loss recognized. The target has no gain or loss recognition. The target shareholders have no gain or loss recognition at this point. They've got the acquirer's stock. There's no gain or loss recognition yet. The acquiring corporation gets a carryover basis. The holding period tax, in other words, is added. So if that corporation held an asset for 10 years, the new corporation is held it for 10 years. T's tax, the target's tax attributes stay intact. So if there's net operating loss carryovers and stuff, you might be able to use them. A lot of times there's some restrictions on how much of that stuff you can use, even in a tax break. There are some restrictions sometimes. The T shareholders' basis in their stock carries over to the acquiring corporation stock. I don't know if they had it right. I think they meant A. Okay. So in other words, T shareholders don't have T stock anymore. They have the acquiring corporation stock, but their basis is what was their basis in their original stock, in the target stock. Reorganizations, which are the so-called tax-free, 368A1. There's two types: the acquisitive, and see this book says the acquisitives are A, B, and C. That's where you just acquire assets or stock. The divisive is usually where you end up with two corporations because maybe there's liability exposure or assets that you don't want. You put those in that corporation, so you're dividing up. Usually have two different lines of business, that sort of thing. You know, all this stuff, the reorganization stuff, there's the continuity of there's all sorts of rules about continuity of interest, and in the regulations we'll look at some of that. So it can't be fraudulent, there's all sorts of things like that. So A, B, and C are acquisitive. D and G are diversive, although this one says G can also be acquisitive. And again, I'm not trying to test you on this. I just want you to have heard the terms. Okay. All right, reorganizations generally. The acquiring corporation, they use their stock. They may or may not use other assets, which of course is boot. They give the stock to Target. Target gives the assets back to the acquiring corporation. Now the Target has the acquiring corporation stock and maybe some boot. And if they distribute all that to the Target shareholders, there is no gain or loss to the Target shareholders. If for some reason the Target corporation kept the boot, then they're going to have to recognize some gain. So as long as they distribute the boot, everything they got, in other words, to the old shareholders, they're okay. But that's one thing I saw. Okay. Reorganizations generally, the Target no gain or loss is recognized, even for boot received if boot is distributed to the Target shareholders, what we talked about just now. Depreciation recapture will follow the asset. In other words, it's a reorg, so a carryover basis type thing. And if you have 1245 recapture, it stays with the asset, and now it belongs to the acquiring corporation. The assumption of liabilities does not cause gain recognition where it might in a taxable transaction. T shareholders, they have a carryover basis from T stock to their acquirer stock now. If they did receive boot, there may be a gain or loss when they sell their T stock. If they hold on to the T stock, there's not. Okay, for the acquiring corporation, no gain or loss is recognized on the issuance of their own stock. I think we've seen that before. There is a gain or loss on non-boot, non-cash boot distributions to T. Probably section, well, actually, 311 would force recognition of gain. I guess loss also here, so that's interesting. A gets a carryover basis, but they get to add to their basis any gain recognized, and they get to add the holding period of the Target corporation, how long they had that, they had that. Okay. And this is one that when I first looked at it, my eyes glazed over and I went to sleep. And then I said, well, wait a minute, now let's just, so we've got the acquiring corporation. They get stock with 120 plus cash of 30. And I don't think the acquiring corporation has to recognize any gain because they use cash. If they use property that was appreciated, remember 311 would at least force recognition of gain. So we've got the Target. The Target, let's see, they have property that's worth 150, has a basis of 60. They've had depreciation of 20. So if you think about it for a minute, the acquiring corporation is getting this property, and they're going to, it's a reorg, so they're going to get the basis of the Target 60, and the section 1245 depreciation taint, it goes with that asset. So if they sell it at a gain later, just like if the Target had sold at a gain, at least the first 20 of the ordinary income. Okay. Okay, now the Target Corporation, let's see, they receive stock in cash, and as long as they distribute it to the shareholders, that's going to be fine. The shareholders are going to give their T stock back to T, and T's going to give them A stock, plus any boot they receive. The Target shareholders, whatever their adjusted basis of their stock is, plus any gain recognized, minus money received, minus fair market value of property received, that'd be their basis in their stock. Again, because it's a tax-deferred, reorg. And their holding period, how long have they held their Target stock? 3 years, well then they held the acquirer stock for 3 years. Okay, Type A reorgs. Mergers, consolidations, okay. The triangle mergers and the reverse triangle, they sound complicated, but again, I think by you being exposed initially to having at least heard this stuff and everything, when Paul will touch on some of those, and he'll tell you why you do it. And I think once you get the reasoning of why, it becomes very understandable. So again, I've taught this twice before, and I used Paul both times, and he's just outstanding. But I never gave them those students anything on this, so it was just like all of a sudden they got it. So I think you're going to benefit from us having struggled with this. Okay, that's my feeling. So mergers, consolidations, triangle mergers, and reverse triangle mergers. Again, he will get into some of those a little bit later. So, okay, so this is the merger. We've got A giving their stock and some property, if any, not very much. Target gives back assets and liabilities. Target distributes A stock plus property, whatever they got, to T. T gives, the T shareholders give the stock back to T. They now have A stock. So that's that continuity, that continuation that you need. And the target is liquidated, because maybe you don't need it. So after the merger, still talking about after the merger, we've got A's original shareholders own stock in A, and T's former shareholders own stock in A. Remember we had the survivor? Okay. The reorg consolidation, we end up with, and this one, this is where my mind's getting blown here. So we have two targets. And A plus B equals C, so that's new C, if you will, new A. Right? We have a surviving corporation that's the combination of everything in the prior two corporations. So stock of A, property is going into target 1, and stock of A, the property is going to target 2, and they're going to give A stock and property to the shareholders in both cases, and they'll give their T1 or T2 stock back to the corporation. What you end up with is the consolidation, and it's T1's old shareholders. Yeah, okay. So T1 and T2 have stock in the new C, if you will. That's the argument. Now, with the Type A reorg, there's some rules that have come out from the cases and from the regulations. This is one that you might see. A stock must comprise 40% or more of the stock, cash, property to target. So 60% could be non-stock and it would still work. The target has to go out of existence. Now this 40%, believe it or not, is not actually a perfect number because there's 38%. It's 38 to 40. It's based on some cases, 38 to 40. The IRS ruling position is if it's 50% or more, we'll give you a ruling, a favorable ruling. So that's the so-called safe harbor, I think, 50% or more. But 38%, which it seems kind of low to me, but anyway, that's been around, and again, it's 38 to 40. The target must go out of existence, yes.
It says stock, cash, and property to T, and then it says 60.
So you don't have to use all stock in this. And sometimes you don't want to use all stock.
But the 40% has to be on stock. Right?
Yes. Yeah. Okay, what's the advantage of an A reorg? The acquiring corporation can use property and cash along with stock to buy the target assets. Key, not all of the target assets have to be purchased. Big deal there. Again, you have the lower 38 to 40, which is really low, and you don't have to buy all the assets. There might be assets you don't want. There might be a building that's built on tainted land. Is anyone familiar with what tainted land is? You know, where you have all sorts of responsibility if you buy it. to clean up for what everybody else did. This is why trustees, banks and stuff, they have to do a level 1 or level 2, I forget what they call them, but research to make sure there's no contamination, because they don't even want to hold it as a trustee. They do not want to own it as a trustee. They don't want that. We don't want the land. We don't want it. If you want us to do that, you have to pay for these reports, which are expensive. So that's, trying to clean up our country. That's one of the costs. Okay. Type A reorg disadvantages. You have to meet state law requirements, which can be a problem. All of the target's liabilities must be assumed, including unknown ones. So even though you can pick and choose the assets, you have to take all the liabilities, including unknown liabilities. So mergers and consolidations, basically you are taking all the liabilities, including hidden contingent liabilities. You think about, when would that come up? I was involved where we were going to acquire, a corporation, and they wanted to sell the stock. Well, that's what sellers want to do, right? Okay. And my client says, well, I guess I can do that. They hadn't made the deal yet. And I said, look, how the hell do we know they've really been qualified as an S corp? What if the IRS comes in and says, oh, 10 years ago when you set up, you screwed up, you didn't file on time, and there were a number of years, this was back in the older days, when the IRS was a killer on that. You did any mistake on S corp filing, and you were disqualified. Now they have authority, legal authority, I think since 1982 or something, where they can come, oh, well, you made a mistake, but that's okay, you're a good person. And they just, I can't believe, all these screw-ups that they say, oh, that's all right, that's okay. But they weren't always that way. So if you bought a corporation and it was an S corp, that was a double whammy. It might turn out it wasn't an S corp. Well, if it wasn't an S corp, what is it? It's a C corp. What is that? Double taxation, all these distributions. Oh man. So anyway, that's the issue. Okay. Now disadvantages. You got to take all the liabilities. Transferring titles, leases, or contracts might be difficult or impossible, depending on what you have. Dissenting shareholders have a right to be cashed out. So you have to come up with some cash there. Okay, I don't want to get into the drop down and stuff like that. So, and the triangle mergers again. You can look at this. If he goes into that and you don't understand what he's saying, at least you got something else to look at. But he's pretty good at explaining stuff. So we're not going to do the triangles and the reverses and all that. Okay. And there's rules about how much you have to buy of the target's assets. Remember we said you can pick and choose, but you still have some rules about what you have to buy. Okay, C reorg. So step 1, we have A's voting stock plus some cash or property. It's a target. Target sells substantially all of their assets to the acquiring corporation. 3, they distribute whatever they got, A stock plus property, that's a T. T gives their property, the T shareholders give their property to the target, and T usually dissolves, but doesn't have to in a C. There are times when you want to keep a corporation alive just for its name to make sure nobody else gets the name. So that'd be a reason. So we end up with we end up with old T shareholders own A and A shareholders own A, and the target may or may not have been liquidated. C reorg. You can only use A voting stock. Oh, that's kind of restrictive, isn't it? A voting stock. A can also add cash or property, but needs to buy a minimum of 80% of the target's assets with voting stock. Up to 20% can be bought with cash or property, so 80%. A can take on the target's liabilities. Let's see what else. If A pays with A stock and cash, then they can take on a maximum 20% liabilities compared to. Okay, so this is where you don't have to take on as much of the liabilities. If you only use stock, Liabilities can exceed 20% of fair market value. Again, I can't really think, when you want to take on liabilities or not, but, so I'm not really sure the logic on that. And again, I'm not too worried about that. Okay, type D reorgs could be an acquisition or a divisive reorg. You must acquire substantially all of the target's assets. The target or target shareholders must control A immediately after the transfer, more than 50%. Looks to me like the acquiring corporation became the target, doesn't it? Anyway, the target must liquidate, target must distribute A stock and profit to the target shareholders. So the target must be in control immediately after the transfer, the target or the target shareholder. And so here's a picture. We've got the acquiring corporation, 50% voting stock or 50% total value of all property. They get the target. The target gives the acquiring corporation the assets. They distribute the stock of A to the T shareholders, and then the target liquidates, but it has to be enough stock where T shareholders actually control. So after you're done, you have A shareholders own A plus T shareholders own A, and they have to be in control. The target shareholders have to be in control of the deed. This is probably too deep, but if it qualifies for both C and D, then it's a D reorg. Again, I don't know. I don't care at this point about that. But there are all sorts of code sections. You kind of have to know the rules of two of them apply. We're not getting that deep. The tax consequences to the acquiring, the target, and the T shareholders are the same as in a C. A B reorg. A's voting stock, and they get T stock. It has to be at least 80%. And this is acquiring the stock from the shareholders. The target stays in existence. After the reorg of B, you've got A shareholders and T shareholders that own the acquiring corporation, and the acquiring corporation owns the target because they own the stock, 80% of the stock. T's minority shareholders have to be 20% or less. In this case, the target shareholders don't recognize gain or loss. The target shareholders have a carryover basis. A has T shareholders carryover basis and T stock, and the holding period is added or tacked. With a B, A can only use voting stock. They can't use cash or property. So this would be kind of restrictive as to when it would work, right? It's okay to exchange the acquirers and target's debt obligations. A needs to own at least 80% or more of the T stock, the control requirement. It could be acquired over a year, and you can do drop downs and triangles, but again, okay, divisive, this stuff, split off, spin off, and split up. This is an area that I really got excited about when I started looking at it, and then I decided, no, I'm not that excited. Okay, so I don't care about this. I don't think Paul's going to get into it much either. Recaps, recapitalization, we talked about that. The F, change in identity, and G, bankruptcy. And okay, now, this is good to know the whole idea that overlays all of this stuff and why we have the reorg stuff. Judicial restriction on reorgs. Now, what does judicial restriction mean? Case law, courts. Okay. Overlies the code and the regs and imposes additional requirements. Okay. Continuity of proprietary interest. It's got to be 40% or more, and I told you 38 is worked in the case. Of A stock, got to continue. Continuity of business enterprise, continue T's business. A business purpose, and then they can come in and use the step transaction doctrine. You have to be sure you can survive that. So proprietary interest, continuity of business enterprise, and like the chapter on that goes into that stuff. Business purpose, requirement, etc. Okay. All right, tax attributes. The general rule is the acquiring corporation gets the target's tax attributes in a reorg. Certain of T's attributes can't be inherited by the acquiring corporation, so NOLs, capital losses, earnings and profits, credits, inventory methods. The acquiring corporation doesn't get those. A can use T attributes to offset A's income only after the date of acquisition. I don't know if that's clear enough. A, C, and D acquisitive can assume the attributes. This is getting probably beyond what I wanted to do. Okay. This is 382. Okay, so.
Because if you go back to where you have the T's attributes that cannot be inherited, so the third one for that, the tax attributes.
Right there.
This one? That one? Can you see that if this is what you do for a living, then you're really interested in all these rules about when can you get the NOL, when can you use it, when not, when would a 338 election be valuable to the acquiring corporation? You know, those sorts of things when you really get into it. Yes, sir.
Do you have access to this PowerPoint?
Yeah, it's on cameras. Yeah. Yeah. So I put it on there, but again, I'll be honest with you, I looked at it after I put it on there, I went through it, and I went, this is really up. So I felt like, when I looked at it the second time a little slower, and that's why I kind of went, through it with you. I think now you've got some sort of feel for it. Okay, the whole idea is I just didn't want you walking into his lectures and stuff, not knowing a doggone thing. So I think now you have something that you didn't have before. I don't know what I'm going to ask you on the test. I haven't made up the test yet. I'm going to make it up probably in the next couple of weeks because we have it on the 16th. Yeah. So, but I mean, I don't foresee something. Those of you that have had me before kind of understand. If I don't teach you something really thoroughly, where I understand it completely and I get that to you, I'm not going to test you on stuff where I've kind of brushstroked this. Now I've gone a little deeper than I thought I would, but I mean, but I want you to have the overall picture, which I think you will. So you might get an overall picture type question. You might get a question about, what's a C reorg, what's a B, but the kind of stuff you're going to have in your textbook. You're going to have your code, and then, just those sorts of things. So I'm not going to try and kill you here because there's a bunch of other stuff that we went into in great detail that I feel like I can ask you about. So that's kind of where I'm at. And if it turns out I ask you something that no one does well on, then I'll curve it out of the test. So when you take the test, just have one rule. I'm not going to get mad at Larson no matter what question you ask. Because I will be fair. Seriously. No, I know how that is because I took a test one time and the professor had told us in law school, this will not be on the final. Somebody asked me, he said, you don't need to worry about this. The one question that was on the final was that question. And I couldn't go home to my wife. I was so angry. I was down to 160 pounds and I had my track shoes in the car and I went out and I ran a mile on the University of Miami track at 11 o'clock at night. And I think the fastest mile I ran at that point was 6:15. Without warming up, I ran that mile in 5:45. And then I could go home and at least not treat my wife like she did something wrong. So, and then we went to the dean and we argued our case. Well, we're in law school, we shouldn't do arguing. And he had to back down on it. But he said, well, that could happen in court. Yeah, right. I understand. Okay, folks, let's take a break now. This will be a 15-minute break, so enjoy yourself, walk around, whatever, but you must take it. But I would encourage you to go back and read it. I think you'll get a lot more out of it this time. This gentleman right here said, I can't see the PowerPoints that you added, and it turned out the little cloud was there and I hadn't published it. I love cameras. Anyway, anytime you all see something like that, send me an email or something saying, I don't see it, because I didn't know that, so he pointed it out. So anyway, I published them. I think I have a liquidation of subsidiary one in there too. I didn't know if that would be useful or not. We don't have time to go over it, but it's there for you if you want to take a look at it. Okay, so on page 265, overview of non-taxable reorgs, and just some of these cases. If you want to make a little note by them right there at the top of your chapter on page 265, the Nelson case back in 1935 was a continuity of interest requirement, and it dealt with non-qualified preferred stock. You remember that term, non-qualified preferred stock? And 38% was okay. That's where the 38% came from. And again, I don't have you memorize case names unless I tell you you need to memorize it. But anyway, so that's the 38. That's where the 38% came. The Paulson case in '85, it flunked the continuity of interest requirement. And then Honberrier, it flunked it also because, let me just get their terminology. Let's see. Okay. The continuity of interest enterprise was not present when there was no intent that the assets would be retained after the merger. There was no intent that they were going to retain the assets, so the continuity. Again, I don't think you need to look at those cases, but it just kind of dealt with that. So the introductory stuff is cool, and the regulations that they make reference to sometimes, let me just take you to one that I thought was appropriate. So what's happened is after all these cases, and the IRS lost a bunch and didn't like it, so what the IRS does when they lose is they try to get Congress to change the law, and if Congress won't change the law or do statutes, then they write regulations. And tell you how if you want us to give you a favorable ruling, you'll follow some of this stuff. And they put examples in there. If you have the new code, I'm in around page 1453 of the new Internal Revenue Code. If you have an older one, I'm looking at 1.368 from the reorgs -1, little e 2. Example 6. So I'm on 1453, right-hand column, example 6. So this is just, again, is anybody there? Are you close? Yeah, it's 1.368-1E2. It's all the examples. Got it? Okay, so I'm looking at example 6. New issuance. The facts are the same as 1, whatever that was, except that instead of cash, the target shareholders will receive a new class of P securities that will be publicly traded. In the aggregate, the securities have a stated principal amount of $60 and bear interest at the average rate during during the 10 years prior to the potential reorg. And they go on, and then about 15 lines down or so. Whether the transaction satisfies the continuity of interest requirements determined by reference to the value of P stock and P securities to be issued to the target shareholders. And then moving on, because for continuity of interest purposes, the T stock is exchanged for $40 of P stock and $60 of other property, the transaction preserves the substantial interest of the value of the proprietary interest that's satisfied. That's 40%. It's in the red. Now they have a ruling position. I think if it's 50, I don't know if it's more than 50% or just 50% or more, where they'll give you a favorable ruling. And there's so many millions of dollars involved with this stuff. I think you gotta, get rulers. Okay. Okay, so 266 of the textbook. They kind of give you some of the history and the requirements. Look at that first complete paragraph on 260. Most of the detailed requirements of the statute are harder to justify, and then they go on and go off. You drop down again about 5, 10, 12 lines down. The rules for reorgs thus evolved through a series of interactions among Congress, courts, and more recently, the Treasury through regs. So, bottom of 267, the basic patterns. They kind of look at that. So, acquisition of stock of target, generally thought to be B. Acquisition of target, C, of target assets, C reorgs, and transactions whereby corporate structures are combined by operation of the law, those are A, reorgs or statutory mergers. And again, I think that if you reread this, and it isn't very long, I think that that will be good for you. I don't think I'm going to reread it right now. On 276, there's the continuity of business enterprise. 277, continuity of shareholders. Those are just big captions there. So just kind of covering that stuff. On page 279, the business considerations. And it says the A reorg is the most flexible in terms of the nature of the consideration that must be offered, since only 40% of the value of target must be represented by acquirer share after the transaction. So that's that 40%. Now it begins to make sense. The 40% is up in the A reorg. Next paragraph, A reorg is also the most flexible in terms of target assets that must be transferred. So long as you meet the continuity of business requirement, target may dispose of assets prior to merger, or acquirer may dispose of some acquired assets in connection with the merger. Next paragraph, despite the ease in which the transactions can achieve tax-free reorg treatment, target's liabilities frequently have made the A reorg unattractive. All of A's liabilities must be acquired, contingent or fixed, documented or hidden, like tort, civil litigation, tort or environmental. I told you about environmental stuff. Not only do target's assets remain subject to target liabilities, but the acquirer's assets could be exposed. So that's a problem because you took two and you ended up with one, right? A plus B equals A or A plus B equals C. You take everything. So again, like I said, this stuff makes a whole lot more sense when you read it again. So as exciting as that was, let's go ahead and take a look at the question. And some of these you can guess at the answer, and you can probably get the answer correctly, but you wouldn't really know why. You just know how to take tests. Nothing wrong with that. It's a skill that many students need. So, okay. Oh yes, I do need to collect it tonight. Yeah. Thank you for reminding me. Okay, so let's see what Alex says. Okay, I wouldn't do that anyway. All right. Okay. Question number one. Oh, and by the way, the lady was pregnant, had her child, and apparently she's healthy and everything. You know what I mean? Yeah. So she sent me an email, and we're doing great or whatever. And That's number 3. Okay. In order to meet the common law continuity of interest test, and what's common law? Courts, case law. Case law. Required for non-recognition to be available in the corporate reorg, all shareholders of the target corporation must be shareholders of the acquiring. All? You knew that was wrong, but why? Well, didn't we have 38 to 40% back up there in A? Okay, so, answer B, it's answer B, which is false. Continuity of interest as currently interpreted does not look to see if the target shareholders themselves remain. It looks to see whether enough of the value of target remains in the hands of target shareholders in the form of equity in the acquiring corporation. Whatever they got from the acquired corporation, which is going to be stock, right? Most of the time. Okay. The general rule is that somewhere around 40% of the consideration used by acquirer must be acquirer or stock. And again, in case the old case said 38, that gives you the idea. And again, that's up in the mergers and acquisitions. So that's false. Number 2. Virtually all the reorganization provisions are premised on the idea that if the transaction should be non-taxable to the target, it should also be non-taxable to the target shareholders to the extent they receive acquirer common stock. Now that's actually true, isn't it? Yes, it's actually true. Because it's just a change in form, which is kind of what the reorg is trying to say it is. It's just a change in form. And now, are there any shareholders that are going to recognize gain in a tax-free reorg? Yeah. Number 1, if you buy out the minority for cash, right? Clearly, that would be a situation. Number 3, since the repeal of general utilities, a corporation that transfers all of its assets to another corporation will recognize gain with respect to those assets unless 351 or 332 applies to that transaction. What do you think about that? It is false. You know why?
I put under section 361A, the target corporation recognizing the gain or loss on the exchange of exclusively for stock in another corporation that is a party to the reorganization.
Okay. What the answer book says is that you are correct, and that it says the repeal of general utilities did not affect the tax treatment of reorgs. It did not affect reorgs. It affected what? When you liquidate a corporation, there's no tax type of thing. These target corporations that transfer all their assets to an acquirer by actual transfer or as a result of a statutory merger will not recognize gain on the transfers, assuming they comply with the reorg provisions, even if they neither control the transferee, so 351 is irrelevant, or were controlled by the transferee corporation before, so 332 doesn't apply. So that's the technical answer to that. Probably a little too technical, but anyway, the reorgs aren't affected, so that's false. Next one. The judicial doctrine conditioning qualification as a reorg on the continuity of shareholder interest has been entirely replaced by the express statutory provisions governing the nature of the consideration that can be received by the target shareholders. Well, again, wouldn't you guess false? Entirely replaced? Okay. And the reason on number 4, it's false, although it's true for many reorgs, it's not true for 368A1A. In other words, an A, statutory mergers or consolidations, when target merges directly into the acquirer and common law doctrines still control mergers and acquisitions. And that's because you've got state law and it's all different too. So case law is going to apply more clearly. Okay. Number 5, 368A1A and the related sections dealing with tax treatment of shareholders and corporations involved provide non-recognition to all shareholders in any transaction that qualifies under state law as a statutory merger. What would you guess on that? Again, all. I guess false, but okay, so that's number 5. Let's see. 5, yeah, false. This is a position taken by taxpayers in early cases when the continuity of shareholder interest and continuity of business enterprise was first elaborated. These doctrines require that the target shareholders get continuing equity interest in the acquirer and that neither historic assets or historic business remain in acquired after the transaction, and, of target, and that's not true anymore, so it's gone. Number 6, a target shareholder can receive readily tradable stock at a corporate reorg without having to recognize gain on the target stock that they gave up. Can you receive marketable stock from the acquiring corporation and still qualify under the reorg? What do you think? Yes, absolutely. Absolutely. Tradable stock. Number 7, Al's a shareholder in Targetco, which is about to be merged into Publico in a transaction in which all Targetco shareholders will receive common stock. So everybody's getting common stock. Al purchases stock for $5,000. He's a 7% stockholder. He's going to get Publico stock worth $100,000. What will be his basis in the Publico stock? Well, does it qualify for a tax-free reorg? Is he getting any boot? No, then his basis is his old basis of $5,000. Let's see what else. A merger, this is the feedback. A merger which Publico uses only stock as consideration will be a reorg under A. So Al can exchange his stock for Publico without gain under section 354. His basis is the same based on 358A1, and that's the basis. Okay, that was 7, right? Okay. 8. Al's a shareholder about to merge into Publico. They're going to get publicly traded bonds. Everything else is the same. Well, how much equity do you get when you get bonds? It's 0, isn't it? Not a Zippo. So doesn't that flunk something? That can't be a tax. And that's correct. His basis is going to be, okay, the question is what's his basis? So what's his basis? Oh, is it 0? If he's going to have to recognize a gain, his basis is going to be $100,000. The fair market value of what you had to report on your tax return. If you didn't do that, he's going to get hit again when he sold it and still have to carry over basis for another $95,000. That'd be double tax. You get it? Okay. So the answer is $100,000. The transaction will not be a reorg because they didn't receive any equity. It'll be taxable, and therefore he takes his bonds at the cost fair market value basis, which is cost basis is fair market value.
So he just loses the $5,000, or you just recognize it?
No, now he'd have a 95 gain. But he had, but the thing is though, that, let's see.
Because I thought it was like,
No, I think he's going to report 95 gain and he'll have a basis of 100. Yeah, he's having to report the gain now. It's not, doesn't qualify as a tax-free reorg, it's a taxable reorg. Okay, so that was 8. Number 9. Al is about to be merged. Most Targetco shareholders will receive common stock. 3 shareholders owning 15% held out are going to get cash. What's his basis in his stock? Well, does it qualify as a reorg? Yes, you could 15%. They say the test, let me just read it out. Let's hear it. The answer is $5,000. This will still be a reorg, even though some shareholders are completely eliminated. The concern with continuity of interest is how much of the value of Targetco remains represented by Publico stock, not the number of shareholders continuing. And they mentioned that the 40% test, again, somewhere, maybe I did. Now, I need to point this out. Those shareholders, that 15%, those shares, don't they have a taxable gain? And their basis in their stock will be fair market value. You see? They didn't talk about that, but you don't want to miss that. Question 10. Al's a shareholder about to be merged. All shareholders are going to get common stock. He bought his stock for $5,000. He will receive stock worth $100. More than 65% of the shareholders have indicated they're planning to sell their stock in Publico as quickly after they receive it as they can. He plans to hold on to his stock. What is his basis? It actually still just fine. It's going to qualify. Here's what they say. The transaction is still a valid reorg. The regs, and that was that one that I read you, the 1.368-1 little e example 6. Prior to the promulgation of this regulation, and in several litigated cases, the service has frequently insisted that supplement sales, where they were planned, could defeat reorg treatment if they result in a situation where less than the requisite, which they're saying is probably 40%, equity remains in the hands of the historic target shareholder. And the question 11.
Because I'm confused because from my interpretation of that, that would say flunks.
You talking about 10? Just the fact that they're planning is irrelevant to what they're saying.
Okay, so it's
Yeah. And the regs back that up now, that example backs that up.
so that they actually did.
Yeah, even if they did. They said they were going to do it, and then later on they did. And the IRS before that was apparently were winning those cases and say, well, that's not a screw the reorg. You know, they probably used a step transaction thing, but the regs finally changed that. And I don't know if they lost some cases, and then they did the regs. That's usually what happens. Okay. Number 11. Alice, etc. He's a shareholder. They're going to merge into Publico. All the shareholders Targetco are getting common stock. What's his basis? Well, this is actually still going to qualify, so his basis is going to be fine. He'll get the stock after the merger. Publico will drop the assets of Targetco into a subsidiary, and the transaction will qualify under 351. What's his basis? Well, that doesn't just qualify either, and that's like one of those drop-down things which I didn't go into. And if you think about it, why would you want to put those assets in a separate corporation? Well, maybe they expose your parent corporation to total loss. So if you put it into a subsidiary, it's traditionally been effective to at least, limit the liability to the assets in that sub-unit period. So that's apparently okay. Okay. Now let's do the discussion problems. 5. Okay. Determine whether the following transaction can be treated in reorganizations, or how they can be treated. You assume that all cases of the corporation in question are acting pursuant to their state's merger law, and that target merges into acquirer, and that there's adequate continuity of business enterprise with the shareholders taking back the consideration stated. So the first one, each holder of one share of target stock, the only stock outstanding, gets 85 cash and 15 stock. What do you think? That flumps. They didn't make 38%, did they? That one flumps. Okay. The next one, they get 35 cash and 65 stock. Yeah, they're above the 38 to 40. And let me just look at the explanation of that, because they threw something else. Yeah. A good A reorg satisfies the 38 to 40%, and in fact, it satisfies the 50% safe harbor rule provided by that. There's a rev proc, revenue procedure, rev proc, that says, I guess it's 50%. It's a safe harbor. If you do that, you're golden. Next one is C. Each holder of one share is going to get 35 cash, 65 preferred stock. The preferred stock is limited and preferred as to dividends, does not participate in growth, bears a cumulative dividend measured by an interest index. So this gets a little more complicated. Now, this one says it's a good A reorg, but you're only going to get non-recognition at the corporate level. So the continuity of interest, 38 to 40, assuming this preferred stock would not be reclassified as debt. So when they start saying assuming, what does that mean? There's an exposure here where it could be argued that you lose. It qualifies as equity interest and satisfies the requirements. The use of preferred stock with a dividend that varies with respect to the interest index, however, is non-qualified preferred stock under 351G, therefore will be treated as boot, not stock, to the target shareholders. And so the target shareholders are going to get this stock, and it isn't going to qualify as stock, it's boot. So kind of tricky there, but it's going to be boot. So it'll be a taxable transaction to the target shareholder. Okay, that was a little tricky. Okay, D, each holder of one share will get stock, common stock, which is the only stock, 35 cash, 65 acquirer preferred stock, which is limited, does not participate, and is subject to redemption by acquirer 3 years from the date of the transaction. And they said, no, it's non-qualified preferred stock again. It's the same answer as C. It's non-qualified preferred stock. It's boot. So the target corporation shareholders are going to recognize gain. It's boot.
So C was no or yes?
Say again?
Was C no or yes?
C, let's see, C was a good reorg, so D is a good reorg.
Oh, D is the.
D is a good reorg also. Okay, so A flunked, B was good, C was good, but the the corporate level had the non-recognition under the reorg, but the shareholders, the target shareholders ended up treated as boot, so they ended up recognizing gain, so it's taxable to them. And D was the same answer. Here's what they said. See the answer to item C, since this appears to be non-qualified preferred stock. Now, listen to this. The answer may depend upon the nature of the formula for the redemption price. Again, beyond the scope of what we're doing.
Well, this is what we kind of found. I saw since it was like a 3 years transaction, wasn't there like something in the book that said that since it was a limited time, that it bumps it as a reward? It's not continued interest.
No, but see, they've already got the stock. I mean, it's just the stock is provided. They've already got whatever they got. So I think that's different from a transaction taking more than 3 years. You understand what I'm saying? Yeah, I see your argument, but I think it's different. Okay. E, each holder of one share receives 35 cash, 65 stock of mega corporation. A corporation is not related to the acquirer. Gee, do we need to go any further? Doesn't this flunk? Yeah, this flunks. There's no continuity at all. Mega is not a party to the reorg. Okay, now. Let me just, I thought they talked a little more about this. What if Mega Corporation was a party to the reorg, and they really were related? I think that would change the answer. And now I see that. Okay, so E flunked. It's not a good reorg. F, 60% of the holders of target stock receive nothing but stock. 38% receive nothing but cash. That's a good one. The standard looks only to the aggregate consideration used. It doesn't depend on whether they got stock or cash. It's the aggregate consideration used. Okay. G, 38% of the holders of target stock get nothing but stock. 62 get cash. Well, that's that old case. Wasn't it 1935? I don't. If I had a client, I'd say, well, there's a 19 case that supports this. It's kind of old, and maybe we better do a little more than that because this is too close to the line. We might lose, and the IRS might be waiting for us because they want to try that again and win. You see what I'm saying? Okay, so because I don't think that 38% was the Supreme Court of the United States case. It wasn't. So, okay, so that's G, yes, but barely. That's what it says. Each shareholder target gets common stock 35 cash, 65 acquirer stock. 6 months after the transaction, rival co, not related to acquirer, makes a tender offer for the stock of acquirer, and which all the old target shareholders sell their acquirer stock. Well, they're not a party to the transaction. I don't think they affect it. I think the reorg's good. Okay, so that's okay. It says so long as rival's not related. They do make a reference to a reg 1.368-1E3. If you want to write that down, 1.368-1 little e3. Not related. Be okay. Each holder 35 cash, 65 acquirer stock. 6 months after the transaction, at issue, rival co, which originally acquired in a single private transaction, 80% of acquirer makes a tender offer for the rest of the stock. Does it qualify? Well, this one's a little more complicated, but I think it's okay. If rival was in control of acquirer at the time of the target acquirer acquisition, its later purchase would be clearly counted in determining continuity. Next paragraph, the regulations, the next sentence, provide little guidance as to what means in connection. It's in connection with a potential reorg. If the relationship between rival and acquirer were created in connection with a potential reorg, the result seems likely. The regs don't handle this. Here, however, the acquisition of controlling interest in the acquirer took place months after the target acquirer transaction. So unless there was a connection not revealed, the second transaction should not affect the continuity of the first. And with that, I close the book. All right, Bernie. Thank you.
So it said,